Welcome to today's video, where we unveil the hidden 1% retirement fee trap and explore how a plan you think is inexpensive can quietly drain thousands from your nest egg. We'll move step by step from understanding the fee mechanics to making a high-stakes decision. Save on fees now or preserve future tax flexibility. Let's dive in. Here's our roadmap. First, we expose the 1% fee problem. Next, we quantify the long-term compounding damage. Then, we examine the in-service rollover option and its trade-offs. After that, we explain the IRA Aggregation, or Pro-Rata, rule. We'll follow, with a practical decision flow, a worked example, and concrete steps. Finally, we'll test your understanding with short quizzes and wrap up with key takeaways. Before we begin, a brief but important disclaimer. This is general education and not individualized financial, tax, or legal advice. Your plan's documents and your personal tax situation may differ, and rules can change. Always consult a qualified fiduciary financial planner or tax professional before taking action. Let's address the core problem. Many savers feel confident because they choose index funds with expense ratios below 0.05%. However, mandatory plan administration fees, often asset-based, can push total costs above 1% annually. Over time, that drag is brutal because it detracts directly from your compounding returns. Without a strong employer match to offset the cost, you're functionally paying premium pricing for an account that looks low cost on the surface. Consider a typical long-run gross return assumption of 7%. If your plan's administration fee is 1%, your net return becomes roughly 6%. On an annual basis, that means about 14% of your gross return is lost to fees. While that may not sound catastrophic in a single year, the impact accumulates every year. Because compounding is multiplicative, the repeated skim produces large shortfalls over decades. Over long horizons like 20 to 30 years, a 1% drag can translate into six-figure opportunity costs. Without a substantial employer match to offset the fee, the plan's effective cost becomes significant. When compounded over decades, the difference between 6% and 7% is substantial. Thus, what appears to be a minor annual fee can make an otherwise solid plan functionally expensive. This flowchart illustrates the decision steps. First, confirm whether your plan allows in-service rollovers of vested funds. Some plans restrict withdrawals until age 59.5 or separation from service. Next, decide if you use or plan to use the Backdoor Roth IRA strategy. If yes, rolling pre-tax assets into a traditional IRA risks triggering the Pro-Rata rule, which complicates or prevents clean Backdoor Roth execution. Then, evaluate whether your employer match offsets the fee. A strong match might justify staying despite the cost. Finally, consider whether you can roll into another qualified plan, such as a new employer's 401k with lower fees, which could preserve tax flexibility without incurring the aggregation issue. The possible outcomes are: roll over now, stay in the current plan, or roll into a better plan. Here are practical steps. First, gather your plan's summary plan description and fee disclosures. Second, compute your total cost by combining fund expense ratios with the plan's administrative or asset-based fees. Third, translate the percentage fee into a clear dollar amount. Fourth, verify in-service rollover eligibility and any restrictions, such as age or service requirements, and which contribution types are distributable. Fifth, evaluate the employer match relative to the fee drag. A generous match might change the calculus. Sixth, determine whether you use or plan to use the Backdoor Roth IRA. If so, keep traditional IRA balances at zero to avoid the Pro-Rata rule. Seventh, if you want fee relief and tax flexibility, consider rolling into another low-cost qualified plan instead of a traditional IRA. Finally, document your decision and schedule an annual review to account for changing fees, rules, or employment situations. The IRA Aggregation Rule, commonly called the Pro-Rata rule, combines the value of all your pre-tax IRAs, traditional, SEP, and simple when you convert to Roth. If you attempt a backdoor Roth while holding pre-tax IRA balances, the conversion is taxed proportionally based on the ratio of after-tax basis to total IRA money. This prevents a clean, fully tax-free conversion of after-tax contributions. Notably, 401k and 403b balances are excluded from this aggregation, which is why keeping pre-tax assets inside employer plans can preserve the backdoor Roth strategy. On the left, rolling over now can reduce fees immediately and may offer better investment options. However, moving pre-tax money into a traditional IRA creates an aggregated balance that complicates or blocks the backdoor Roth. On the right, staying in the plan preserves the ability to execute a clean backdoor Roth by keeping pre-tax IRA balances at zero. You continue to pay the plan's administration fee, but that cost may be justified by the tax planning value. Reevaluate annually, considering changes in plan fees, match policies, and your tax bracket. Question: which balances are counted in the IRA aggregation or pro-rata rule when doing a backdoor Roth conversion? Options are A, only the new after-tax contribution, B, 401k and 403b balances, C, traditional, SEP, and simple IRA balances, or D, Roth IRA balances. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C. Traditional, SEP, and simple IRA balances are counted in the aggregation for the pro-rata calculation. 401k and 403b balances are excluded from aggregation, and Roth IRA balances are not part of that calculation either. Question: when might paying a 1% plan fee still be rational? Options are A, when you rely on the backdoor Roth and want to keep traditional IRA balances at zero, B, when you never expect to do Roth conversions, C, when your employer offers no match and fees are high, or D, when you have a cheaper IRA but want more account statements. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is A. If you are using or plan to use the backdoor Roth strategy and value Roth space at a high marginal tax rate, paying the plan's 1% fee could be justified to keep traditional IRA balances at zero. This preserves tax flexibility that may be worth more than the immediate fee savings. Here are the key takeaways. First, a 1% fee drag over decades can easily reach six figures. Second, an in-service rollover may reduce fees but can trigger the pro-rata complication, undermining a clean backdoor Roth. Third, if you rely on the backdoor Roth, avoid pre-tax IRA balances. Fourth, explicitly compare the yearly dollar fee to the strategic value of tax flexibility. Finally, revisit your decision every year, especially when employment circumstances or tax rules change. Let's apply numbers. Assume a starting balance of $60,000, a gross return of 7%, and a net return of 6% after a 1% fee over 30 years. At 7%, $60,000 grows to roughly $456,738. At 6%, it grows to about $344,610. The difference is approximately $112,128. This simplified comparison isolates the fees effect and excludes contributions, taxes, and employer matches. With ongoing contributions, the cumulative gap can be substantially larger. Use a financial calculator or consult an advisor to tailor the math to your situation. This table summarizes scenarios. If fees are high and you are not using the backdoor Roth, rolling over often makes sense to reduce costs. If fees are high, but you actively use the backdoor Roth, staying put may be wiser to avoid pro-rata contamination. When there is a strong employer match, the net value could justify remaining in the plan despite the fee. If you can roll into a new, low-fee 401k that accepts roll-ins, that path may deliver both lower costs and preserved tax flexibility. This timeline shows a practical cadence. In months 0 through 3, audit your fees and confirm in-service rollover eligibility. In months 4 through 6, decide whether to stay or roll based on the employer match and your backdoor Roth plans. In months 7 through 12, execute your chosen path. Either roll into a lower fee plan or remain and optimize within the current plan. Then set reminders. Annually, reassess fees, your tax bracket, backdoor strategy, and any new plan options. To conclude, a 1% administrative fee can significantly erode compounding over time. In-service rollovers can reduce costs, yet moving pre-tax assets into a traditional IRA triggers the aggregation rule, complicating backdoor Roth strategies. If you value Roth space Aim to keep pre-tax IRA balances at zero. Ultimately, compare the immediate, measurable fee against the long-term value of tax flexibility. Reassess regularly as fees, employment, and tax laws change. Thanks for watching. If this was helpful, please like the video, share it with someone who needs to see it, and subscribe for more actionable personal finance content. Post your questions or describe your own experiences with plan fees and rollovers in the comments.